you so much for joining in. I understand that it's being Friday there and it's a weekend for you all, and it's too early for all of this. Secondly, I would like to thank Dr. K.C. Narayan for giving up this opportunity and sharing his wisdom with all of you on how and why financial planning is important and can be helpful for you and for your family. So, this entire presentation is going to be very simple in terms of understanding that what is financial planning and how we should manage our finances and our savings and investments for our future. Along with me, I have Harsh. He's CEO of FinEdge Advisory. So he and me will be taking this presentation ahead. So Harsh, I would request maybe if you can just give a brief about FinEdge and this presentation to all of us.
Thanks, Surabhi. Good morning, everyone. It's afternoon here, but good to have all of you here. And a special thanks to Dr. Narayan for organizing and facilitating this presentation. I know this presentation, while what Surabhi said, it's simple. However, I think the intensity or the meaning of the presentation we've tried to make in such a way where certain information can be shared with you, which will help you in taking your financial decisions. Typically, there are two types of people who have been investing and people who plan to invest. And the idea of this webinar was to exchange ideas or share ideas or wisdom that we have gained over the last 20 odd years in this industry, which can help both types of people. People who are already investing to figure out whether they're on the right path, what can be done, what should not be done. And also to help people, for example, who are going to start off or planning to start off, this should help them plan better in terms of what is the best possible approach towards financial planning. So with that, this basically is the session agenda. We have about an hour of time, which will also include a certain amount of time which we want to spend in answering questions. We do tend to keep this a little generic in nature because unfortunately, portfolios can differ and they can be completely different for each individual. So we try not to get into products and portfolios, but generally talk about what can be a big advantage to people who are investing or plan to invest. Once again, Dr. Narayan, thank you so much for this. We would hope to hear your views as well. Just to give everybody a brief background, Dr. Narayan has been a client of FinEdge for the last almost 7.5 years, almost as long as what the company we've been operational for a little over 8.5 years. So he's been there along with our journey. I'm sure he'll have some thoughts that he would want to share. So we'll involve him at a later stage and keep asking him for inputs in terms of how it's helped him. Whatever questions you might have, I would request all of you to feed it into the chat. At the end of the session, we'll take up the questions and try our best to answer in the best possible way whatever questions arise from this presentation or even outside of this presentation, any questions that come up in your mind. Just one slide before we start talking about financial planning or investments. This is just to give you a little insight in terms of what we do. If we are talking about ways to invest and how to invest, what is the experience that we bring and what is the reason that we are in fact talking about investing. So this just talks a little bit about the company, what we do. We are one of the largest financial planning companies in the country. We manage clients remotely. So based out of the single office in Gurgaon, we have clients across about 55 countries and 600 cities in India. And so that's pretty much what we do. And we'll quickly move from here into where I will request Surabhi. And just to give you a brief background about Surabhi, Surabhi has been with FinEdge for a very long time. Like Dr. Narayan, almost 5-6 years. And she manages a team. She's an AVP here, and directly, indirectly, she also manages some clients directly, but she manages a large team where indirectly she's interacting with a lot of clients. So Surabhi, just in terms of, I wanted to, before we, initial bit of the presentation, I wanted to ask you, as an advisor, as a team leader, what is the basic hygiene that you'd want to have when you talk about financial planning or investments? What are the basic steps that if you were to start off today, what would be in your mind that things have to be done right?
So I think the very basic thing is to understand that what are your financial goals, right? We need to figure out that what are the different milestones that an individual can have that are there to be achieved. So first and very foremost thing is that get the financial plan prepared, because doing investments and just randomly saving your money might might or might not help you. So I think you need to understand your goals. Second thing is we need to prioritize goals. So there could be certain goals which could be short terms, and there could be certain goals which are long term goals, and both the goals are important. So we need to understand those goals and prioritize them accordingly. Next thing is could be is that, see, when I'm talking maybe about longer term goals, 15 years or 10 years, right, there would be lot of short term fluctuations that might happen, or maybe there would be changes in your financial situation. So as an investor, you need to be very disciplined, and you need to be very clear with what purpose you started your savings or investments, or what are the milestones which you have that you need to achieve, which is a very difficult task, because as a human behavior we keep on changing it, or maybe we might react to different situations differently, which brings us to the last basic step, which is that time and again we have to start from the basic, and we have to go back on our goals and revise them, and understand again that with what purpose we started those. So it's very simple, is that understand what are your financial goals, and keep on going back to those goals and see that how well are you moving online to achieve those financial goals of yours. And yeah, so, and another very important thing is that you have to be very disciplined about it.
So how does it really help? So in terms of whether I get a financial plan made or I don't get a financial, let's say I go to advisor and say, I want to invest. Why is it that you cannot give me a investment product and get on? Why do all this lengthy stuff? How does it really help if
I may not be able, yeah. So I may not be able to provide you the right solution, right? So maybe you want to do investment for a shorter run, and I did not ask you that question, and I give you some investment option which are suitable for longer run. So simply when you go to a doctor, right? Doctor just does not give you a medicine without asking that what symptoms you are going through. So as an advisor, I need to understand the problems, the areas where we need to work upon, and accordingly I can give you the right solution for it. That ways I think it would be helpful for you also, and that ways I am doing my job as an advisor. If I am just blindly giving you anything, then I am not doing my job properly, I think.
So what is this? I know, and especially the reason why I'm asking you this is today we have a lot of NRIs,
Yeah.
client and prospects and people who are interested today in terms of understanding what we do. And I come back from my experience in banking. Um, whenever we work with banks, I think NRI clients used to be somebody we really used to value, and the reason for that was not really a great reason because one of the easiest people where you could position certain products which are very beneficial, profitable for the organization, not
Hmm.
necessarily for the client,
Yeah.
used to happen in all these large financial companies because typically, and I'll get specific in terms of all financial companies carry very heavy targets for insurance.
Hmm.
And in my personal experience, I think the maximum amount of insurance sold in the country used to happen to NRIs.
Right.
So what is your suggestion in terms of what is it that you need to be careful about? Because most people do approach whenever they come to India and, spending most of the time abroad. When they
Yeah.
come back to the country, they go to the banker or the financial service provider. What
Right.
would you ask them to watch out for?
So I think the very first thing that all these NRIs clients should watch out is that if someone is just advising you something without understanding your financial plans or goals or your requirement, then you should never go ahead into that, because that is not going to help you in a longer run. So as an investor, you need more than, I think it's a collective job for you and the advisor to understand the financial goals and accordingly choose the right investment product. So insurance, they say that is a good investment tool, but they will not tell you all about it, right? So considering the returns and everything, that will of course go later on.
It is
That
it is it is a good investment tool, but maybe not for the client. It's for
right
the person selling it.
first, yeah.
I think that's one of the biggest conflicts that I have seen in the investment management industry, where um, what is being given to a client is completely contrary to what the client needs,
Hmm.
and it's basically conflict of interest which really arises. And my at this point, Surabhi, I agree completely with you, and this is specifically I think more NRIs need to be very very careful about. um, uh, you must, and my advice to you at this point would be very simple, that if an advisor is not spending enough time with you to understand your basic requirements, needs, goals, objectives, or not making a financial plan for you. 99.99%, without all that information, either the product which is being positioned to you is incorrect or not in your benefit, or the person is actually not even aware of what the person is, what position is being, product is being positioned. So I think my strong advice, at least from our personal experience and for over the last many years, is this should be a dip test that all investors should do. Is the advisor really taking time to understand what you need? And going back to the previous example, it's happened to me so many times. My friends, relative coming to me and saying, "Mera investment, get it done, get my investment done, get my investment started." And my question is the same example that you gave last time. Um, would we even imagine something like that? We go to a doctor and we take an appointment, go into his room and say, "Hurry up, give me medicines."
Hmm.
The doctor's going to laugh. He's
Right.
going to think that there's something seriously wrong, because how can you even go to him and ask for medicine without first explaining
Right.
how old are you, what has happened, do you have any illnesses in the past, what symptoms are you feeling,
Hmm.
etc. What are you allergic to? I think these are very common things. So I think the same thing has to be replicated. We do take illnesses very seriously, but sometimes I feel we forget to take investments very seriously, and I think they're both pretty much as important.
Right.
So coming back to this, I completely, so one piece of advice right in the beginning, if you want to filter, I would strongly recommend, just have a look at this slide and always use this as a yardstick when you choose any investment or an advisor. That would be my first advice to you. The second thing we spoke about was goals. And I think the second most important part of your investment journey would be the goals. And the reason why do we give so much importance? It's so easy to start investing, but if you don't link those investments to a goal, how does it really impact you is pretty much what we want to talk about in the next slide. And it's not just goals. I mean, I want to invest for retirement, I want to invest for XYZ reason, but your goals have to be what we call SMART. That's an acronym. And for SMART, basically, we mean that a goal should meet these 5 criteria. A goal should be very specific. It should be measurable, achievable, relevant, and time bound. For example, each one of this, a small example, if I say I want to, get rich, that is not very specific. Rich or wealth will vary from individual to individual.
Hmm.
It has to be measurable. That means I want to accumulate X amount of money over X amount of time is a measurable yardstick. It has to be achievable. Now, for example, I would want to become the wealthiest man in the world, but you have to be realistic towards yourself. Is that something that I can, as an aspiration, that's great. But your financial plan has to be achievable.
Hmm.
It has to be relevant. Some of the stuff, sometimes we do get into a mode of just wishing for stuff and forget that in the end that complicates the entire financial planning and investment purpose. And it has to be time bound. You have to have a very specific yardstick, and that I think is very important also from an advisor point of view, because when you're investing for 2 years, your advisor will naturally recommend different products. When you're investing for 5 years, the investment advice would change. If you're investing for 12 years, it would completely change. So the portfolio or your investment portfolio actually would vary, not for different people. For example, one person can have 3 different goals and the portfolio will be very different from all three. The advice for all three will be very different. So that's what we call a smart goal. Goals are very critical. Multiple research has happened on goals, and very important if you want to succeed. And this journey is long and it's a tough journey, but if you really want to succeed on your investment journey, I think you have a 78, at least research says you have a 78% more chance of meeting or achieving financial success if you have investment linked to goals. So that's another very critical point. I'll just give some examples of uh, which goals are smart, which are not, just for basic understanding. For example, retiring, whatever is in red basically is not a very smart goal. Retire rich by the age of 55, again, is not very specific. It doesn't define rich. There's no number attached to it. So these are all great goals. I mean, all of us have these goals, right? We want to plan for our retirement. We want to plan for our children. We want to plan for their education. We want to well-being of our family. We want to plan for holidays, etc., etc. But sometimes we don't take out time, or we don't ourselves sit down and evaluate in terms of what is it that I'm specifically hoping for. What am I wishing for it, or is it realistic? So again, the second one is a great goal, pay for my child's higher education without taking a loan, but it completely lacks measurables. Similarly, the third is something which is a smart goal, which is save up to 5.5 crores for my retirement in 25 years of time. If I make this statement to an advisor, there's so much information in just this single line, which allows me to really align myself with a goal, set it up, discuss possibilities, options, and then assign very specific investment tools to meet this goal. So this is a smart goal. Similarly, that I'll just keep putting down. I won't talk about each goal. You can have a look at some of these. The red ones basically are examples of goals, which are very good goals, but not very smart in nature. And the ones which are in black or dark green are the ones which are actually very, very specific and smart goals. Now, while we are giving all this information, one question which naturally would come to me is, why? What difference does it make? I'm saving money. At some point, I'm going to use that money for a very good purpose. Really, why do I need to make it so complicated? And I think what we've seen, one example of this is, we have thousands of clients and thousands of goals. Each goal is critically important to our clients, and we take that responsibility along with that client, and we really want to see our clients succeeding, and we understand the importance of those goals. I mean, imagine somebody who's saving for their children's education or their retirement or an emergency fund or a medical fund, or these are such important goals where we feel to a large extent becomes our responsibility to ensure that the clients get there. But one recent example that I can share with, or actually two examples that I can share with you, is that how it really helps. Just on a lighter side, a few days back, a client called, and he had accumulated a fair amount of money over the last few years, and all, getting into 40s, that midlife period of it. So he came and he told his advisor, all my friends have bought a bike and they go on these drives, and I want to buy a bike. So the advisor said, great, that's a very good idea. So he said, it's a high-end bike, so I'm going to spend some money on it. And I was thinking, rather than taking a loan, I will take some money out of my portfolio. Now, of course, it is the client's money. It is his portfolio. He can choose to take. As an advisor, I think the role over there would be and in this specific case, I think a client had a daughter named Jyoti, and what happened was, the client said, I want to take out money. So the advisor's first reaction was, sure, how much money do you need? So he said, I want X amount of money. He said, sure. So you are saving money for two goals, which is Jyoti's higher education and Jyoti's marriage. From which of these portfolios do you want me to withdraw the money from? And that was it. And so as an advisor, it also allows us, because we are also closely linked to the client's goal, and at this point, to remind that client that, fine, it's your money, but you must understand that by taking out money from any of these goals, it does impact your goals. So immediately the client, of course, understood what we were saying, and he said, hang on, let me come back to you in 2-3 days. And post 2-3 days, he said, listen, I've decided to buy a second-hand one for my hobby. So that's just an example. I'm not saying that money should not be used. It should be used for all the right purposes. But as an advisor, it also allows us to give the right feedback at the right time. But I think one critical example, as this was an isolated example, one example which I would like to give as a whole is what we saw happen in the market in March. COVID happened worldwide. A lot of markets crashed. Nobody saw it coming. And suddenly when you're seeing a portfolio, you see a drop of 30-35% in a portfolio. It's quite painful. And we clearly saw these two, and whether it's the media or articles or questions or people asking or clients asking, we saw very specific differences between somebody who had invested with goals. Of course, it worries everybody. Nobody likes to see their portfolio fall. But in terms of reactions, we saw two different reactions. We saw a client who said, all right, this is all, market cycles. Markets will fall, markets will go up. Luckily for me, my goal is 10, 8, 17, 16 years away. I expect the market to go through various cycles. I'm not worried because I don't need this money right now. Some people panicked completely and said, listen, abhi to, the market is 7,500. It's going to fall further. I want it to withdraw my money. I will sit out of the market. And a lot of people did that. I keep talking to people in the industry, and a lot of people actually moved out of the market at 8,000, 8,500 levels, anticipating to enter the market at 5,000. And till date, the market never gave an opportunity. It crashed 30% in a month and recovered 30% in the next month. And so this is what happens. So I think this gives a little balance to our entire investment outlook. A goal allows you to look at what you want to achieve, rather than daily what is happening in the market. Oh, the today's headline is so and so, tomorrow's headline is so and so. So it just allows, I think, one of the biggest takeaway that I would give as far as goal linked investment is that really allows you to withstand the market. Is not going to make an investor's life easy. It will test an investor at multiple levels, and to a large extent of the foundation or the stability that a goal can provide, especially long-term goals, comes from the fact that your investments are linked to those goals.
So it helps you making a rational or irrational decisions, basically.
Absolutely. I think it gives you insight. So it
Yeah.
allows you to get over the initial panic, because we're all human beings.
Yeah.
We all of us do feel the impact, but it just allows you to think a little more rationally and allow time, and then take a decision, a slightly more calculated decision, a slightly more reasonable decision.
Yeah.
And it's not
But this is,
easy.
yeah.
Yeah. Tell me. Yeah.
So I was saying that what all we are talking, right? Figuring out goals and then just focus on the eye of fish and just not look anywhere else, right? It sounds all very simple. Like, ठीक है, I've set my retirement planning and I know that I have to save this much and I accumulate what we discuss smart goals, right? That I have to accumulate 5 crores by the age of 50 or 55 when I retire. So it's a very defined and smart goal, but and it's simple to understand. But when I have 30 years ahead of me, it might not be very easy to implement on of all of this.
Honestly, Surabhi, it's much easier talking about all of this.
Yeah.
I can talk about financial planning and investments the whole day, but genuinely, as an investor, it is not that easy. So I think which is something which I want to state. Investing is very simple. I mean, you set a goal, you take out some money, and you start accumulating funds, and that is pretty much what. Of course, you start off with a financial plan, and you have your goals, and you start every month setting aside certain amount of money, and that is pretty much the end of investing. So it is actually a very simple concept, but from an investor point of view, such a long journey is full of such treacherous short-term pitfalls. Going through this journey is not easy at all. It is far easier for me to give this presentation and talk about investing, but actually the entire journey of investing is far tougher than we can possibly imagine. And you do require all of these support functions in place, guidance in place, clarity in thought process in place, and understanding. And I think one last thing which is very critical is expectation, having the right expectations. These are the things which will allow you to really meet your goals. And while it is very simple, and if it was so easy, all I can say is everybody in the world would have been wealthy and rich, because investing is not tough. But not even 0.5% of the population of the world gets to be wealthy. That is how tough it is. Yeah. In the same context, I think the next slide that I would like to talk about is, as an investor, what is it, when I'm talking about support functions, what is it that can really, what is your list of friends, what is going to help you to meet your financial goal? So according to me, I've tried to again simplify and lay down 5-6 things that I would like to talk about briefly. Do remember this list. These are your best friends. These are your allies. These are your support functions in investing. Investing is very simple. It is not easy at all. And you need as many of these allies to be on your side. You have these support functions to be there. I think the first thing is, the longer the time frame that you have, the larger the corpus you can create with lower risk, because the markets will go through various cycles and it'll even out. The second thing is, like we've spoken about, so I will not further talk about this, is goal-based investing. It can really help you in terms of meeting your, a few things that in the subsequent slides we'll talk about. One of the most critical things that one of your biggest friends, one of your strongest support long term will be compounding. And it is very important. While compounding, I know we've all heard of compounding, I know we all understand compounding, but the impact of compounding, how much it helps you in your investment, is something that we really need to dig far deeper and completely understand. So that's one thing that we will talk about subsequently. Systematic investment plans, systematic withdrawal plans, these are things which once again reduce risk for you. What is the difference? Ultimately, the investments are going into the same product. What is the difference between lump sum versus systematic? Systematic once again allows you to accumulate money over a longer period, and it also allows you to reduce your risk because you every at a set frequency of every time dipping in and buying stocks at a certain, so it evens out over a longer period of time. One more thing that going forward we'll focus upon along with compounding is behavior. One of the biggest problems that you'll face on your investment journey repeatedly, while your investment journey is very long, but the journey is decided by our reactions short term to what is happening around us. And that is where having the right behavior, once again, we are all rational, reasonable human beings. We all think that I don't need to know, I'm all right, I'm sorted. Is there a disturbance which is coming when I'm talking, or am I clear?
You're clear, Harsh. I can hear
I
you
think
clearly.
Surabhi, I think it's coming from your side. So, is okay. Is your LAN connected?
Is it still there?
Yeah. Is your LAN connected?
Yeah. No, I'll just connect
Yes.
here.
Please connect. Yeah. Yes. Sorry for the interruption. So behavior is another thing that, while I know all of us are fully aware, and the reason why we are sitting in this webinar together is I know that the people I'm talking to are people who have already achieved certain amounts in their life. They're doing well. Um, uh, they are rational thinkers, which is why they're thinking about, or they have been investing, or they think. But behavior can once again be underestimated. Our short-term behavior sometimes can be highly irrational. So that's another thing that we'll talk about. Um, and in the end, I think what is important is what we've already spoken about, um, is if you always understand the process and follow it. I think, I don't know how many of you recently saw, it's been there on YouTube, a small clip of Mahendra Singh Dhoni talking about why he was successful as the captain of India. And he only talks about the fact that, unfortunately, what he has seen around is that most people always focus on the end objective and lose sight of what they're doing. And he's saying, I never think about the end objective, and I go for a game, I break it down into multiple pieces, and I assign a process. If this happens, what am I going to do beforehand? And I just always follow that process. That allows me to be calm, it allows me not to panic, and it allows me to have a sense of structure on what I'm doing. So if you guys do get a chance, please do go on to YouTube, and you can search for Mahendra Singh Dhoni process. And I found it very nice. I like the way he's a very simple person. I like the way he talks. And that was his explanation for being a successful captain of the Indian cricket team. And these are the basic 6 steps that I would always ask you, if possible, whenever you are in a state of confusion or you feel you are reacting to something. These are 6 things, and just see that, am I on all of these steps? And if you are, then I don't think you have anything to worry about. The pot of gold is there
Is
at the end of the
waiting.
day. Yes. So that would be my thought process as far as the allies that are concerned for investing. I think should be what I would next, like I said in this slide, compounding is mind-boggling for me. Compounding is magic.
Yeah.
Compounding is something which is a miracle.
Hmm.
um, I just want you to just talk about, if time, discipline, and compounding is added, how does it really? So while we are talking about it, it sounds good and all of that. Can you give some example in terms of what compounding can do?
So see, compounding is something that happens over time, right? So if I will not be able to see the benefit of compounding maybe in 1 year or 2 years, but if I give enough time to my
No,
investments and savings,
sorry for interrupting, but for example, in this slide, I
yeah.
think if you just show me just this slide, and I'm looking at, oh my God,
So
my
firstly, in
goals
this,
are goals
yeah.
are 8 crores, right? It sounds like a big, or it could be 20 crores, or it could be 10 crores, or it could be five, but this does look like a big number.
So of
So
course, this number is a humongous number. Now, what we have represented in this slide is that we have break down all of our financial goals. So some goal, like a goal is 10 years away, that I want to build up a house for myself. I want to buy a car for which I need to accumulate 10 lakh rupees in 5 years, and then retirement planning for which I have 30 years. Now, each goal has a different time frame. Now, of course, the longer the time frame, um the better compounding I can generate, and the less burden I will have on my savings as well. Which means is that even if I start saving a smaller amount, let's say for my retirement planning, then I would be able to give or reap the benefit of compounding here because I have 30
also
years.
also time, right? Because I think this is not purely compounding. I think the mixture of time,
Yeah,
compounding, and all of that put together, because I think what we are referring in, if correct me if I'm wrong, is also the fact that if you give time to your investment and invest on a monthly basis. So I think the next part of the slide is that really for getting to a 8 crore goal, you don't really need to start investing big. The
big
goal
amount.
can, so I think, um, I, at least the first time I saw this slide, it was fairly surprising for me that one, when I saw 8 crore number, it is a large number, but I think time and compounding put together, um, it does not really, I mean, honestly, setting aside 30, 40, 50, 60,000 rupees a month, I think that's where the role really comes in from a time and compounding point of view, right?
Also, the very interesting part is that if you just notice a bit, like for a 17-year goal of mine for child's higher education, I only need to save 7,500 rupees from today, right? So which is not a very huge amount if I have to keep aside. Just the very important thing again is what the discipline is. Now I have to be disciplined for next 17 years to keep saving that 7,500 rupees, and then I would be able to accumulate this 50 lakh rupees. And when I add up all these goals, I would be able to achieve 80 lakh rupees
For,
over years.
for
Yeah,
me, it's always inspiring. This clearly signifies the earlier you start, what a
correct.
big difference it can make. And I see so many of our clients starting at such an early age. And when I look back, I did make this mistake. I did not start early. So when I look back, I wish I was smart enough to have started this at an earlier part of my life. My life would have been so much easier. Having said that, I don't think it's ever a bad time to start.
Right.
The later you start in time, I think these numbers start going up a little bit because the
Hmm.
time reduces, but
Right.
not so drastically where you can't meet these goals.
Hmm.
So I think the last bit, one, we all know, while Surbhi and I might be saying this and we might not sound very intelligent, let me put in a quote of a person we think who's fairly intelligent. His name was Albert Einstein. And okay, so that's in the next one. So this clearly talks about the fact that, financial goals of a large amount of 8 crores can be saved by putting in as little as 57,000 rupees a month. This can be
Hmm.
even lower if your age is less, or
Yeah.
slightly higher depending on where your age is, right? Um, Compounding, again, I think we spoke about, and this slide specifically, Surbi, I think, I have heard you have this conversation with many clients, and every time, once again, like the previous slide, for me this slide is also a big shock always, and I've seen this slide 100 times, and
Yeah.
every time I see this slide, I it always fascinates me in terms of what compounding can do. And also, to some extent, Surbi, I would want you to talk about the fact that how underestimated compounding is in specifically India and Indians, because a lot of us, and especially at least all my friends, family, somewhere keep getting stuck between very traditional investments.
Right.
So if these two things you can just talk about, and I think this is very important for an investor.
So basically, for traditional investments, it could be like insurance product that I take, right? Let's say I've taken a child's education plan for my child, but the point is that the return that you see in any insurance product that you get is not more than 4% or 3.5%. Now, over years, also insurance product is a very longer term product.
Yeah.
It's not a short time
15,
product,
20,
right?
30 years,
15,
absolutely.
20 years,
Yeah.
right? Now, an investment tool which can give you 4% return, for example the example that we have shown, you'll be able to accumulate 63 lakh rupees from this insurance product. But the point is that PPF is another example that you get 7.1% return, and of course it's a stable return. There is not a lot of fluctuation which you get when you invest into PPF, but the return as on current date, it gives you 7.1 return. And if you do this, then maybe by the time for 30 years you will be able to accumulate 1.24% return. On contrary, if I start saving certain money for 30 years, for example, into mutual fund through a systematic plan, just what we explained in the earlier example,
Which
even
is
with a
just
small
10,000 rupees a month.
10,000 rupees, right? I save this 10,000 on a monthly basis for 30 years, and I'm expecting 12% return on an average. I would be able to accumulate 3.49 crores. And who would not want that money by their side, right? In 30 years. If given a choice, of course, I would pick 3.49 crores. But the only thing is that a product that is giving you a guaranteed return, but that return is very less, and it will not give you benefit of compounding in a longer run. Also, you'll not be able to accumulate a larger amount with that.
Again, I think it's a behavior thing. I think all
Yeah,
human beings, when you see that the stock market will fluctuate, right? You can get a
right,
20% return and a minus 20% return.
right,
That
right,
worries you, right?
correct,
But I think what the enticement over here is the fact that people say, oh, 7% fixed return or a 4% fixed return I'm comfortable with, but not relating to the fact that it's a 20-30 year period. Even
correct,
in such long periods, 10 years, 15 years, 20, actually stock markets also give you a very even return. uh,
correct,
the fluctuation year on year will be very high, but look at the difference. I mean, if I was investing in a traditional product with 4%, and I know lots of people who are saying that, nahi, it's 4%, but at least assured hai, I would
correct,
want to take a 4%. I don't want to take the risk of investing in a product where the returns will vary. But look at the difference to your life. I mean, if I'm saving money for such a long period and I'm getting 63 lakhs versus 3.5 crores with that same investment, I
hmm,
think that puts the spotlight on compounding, the difference between 4% and 12% return.
right,
And really, I think one question which comes up whenever I talk about 4%, or when this debate is happening with other people between 4% or 7% and 12%, the first question which comes up from investors is, yes, but I feel you're exaggerating, because 12% return is something which is may or may not happen in the stock market, which is correct. In the short
hmm,
term, it may or may not happen.
correct,
It could be the reverse. It could be minus 12% as well.
yeah,
But
yeah,
my next slide, post the quote of Albert Einstein, which I was talking about in the previous slide. This is something which Albert Einstein had said, and it truly is. I would not even call it the eighth wonder. I would call it, maybe put all seven wonders of the world put together and put compounding on one side, and I would say compounding is bigger than all seven. It's incredible what compounding can do. And he was a very smart guy. And the real truth, I think, is the last line, that there will always be two kinds of people. Either you are paying for somebody else's compounding,
hmm,
or compounding is helping you build your portfolio. That is how it is. So if you don't have the thought process, the discipline, the maturity, the time, and the product, and a financial plan and goal, then you will be paying for somebody else's compounding.
right,
That is how it is. So it comes to the next slide, which I want to talk about, is that when somebody says, okay, assured versus non-assured return,
hmm,
I want to give a basic example. These are 10, and especially in today's market, I'm sure that people I'm talking to are people who have been investing, who have portfolios, and they would have experienced this. A lot of clients have come to us and said exactly this: I'm not getting returns for the last 2, 3, 4 years. We are going through a market cycle. So many such cycles have happened in the past. And look at a 10-year point-to-point return in any of them. One exception would have been 2008, because this is the beginning of 2008, includes the fall of the market in 2008. But a person who still stuck on and spent 10 years got the highest possible return.
hmm,
So when our assumption in the last slide, what we're doing is at 12%.
yeah,
We also make our financial plans with an assumption of 12%. But these are assumptions that you will remain invested, that your goals are far away. For a 2-year goal, would you recommend equity? Absolutely not.
right,
You
yeah,
have PPF is a great investment, but the
hmm,
unfortunate part of PPF is you can't withdraw for a certain number of years.
right, yeah,
So there are debt funds, there are liquid funds. So again, once for a long term, and when I'm saying compounding, the compounding will not happen over 2 years.
hmm,
Compounding needs time
time, yeah,
for it to take place. So anyway, we're talking about long term goals. So this, again, coming back to the point, these are the 10-year returns.
hmm,
We are currently going through a cycle where an investor can get despondent very quickly.
yeah,
3 years में पैसा invest करे जा रहा हूँ, मेरा portfolio marginally positive है या negative है. It's not a great feeling. But once
right,
again, the thought process that I'm investing long term, I know mean revision. Mean revision means I know that the market will come back to its long term fundamentals and will give a certain amount of return over a longer period. It can be up or down 1 or 2 years. Instead of
hmm,
10 years, it could be 11, it could be
right,
9, or it could be 12. That's the variance that can happen, right? So once again, understanding, having a rational thought process around all of this allows you to not get worried about market cycles. Imagine we thought in 2008 the world is coming to an end. I saw clients' portfolios going down 60% in 6 months. So, and look at somebody who at that time would have continued investing and would have been sitting on a CAGR, compounded annual growth rate of 18%, is unbelievable.
Right.
Now, we've spoken about the allies or the friends that you have as an investor. My next slide is going to be talking about what are the biggest enemies. What are the things which are going to stop you from meeting your goal? And once again, this entire presentation is not about products. To a large extent, it's not difficult. If you have your friends on your side and you're careful not to fall into the traps, you will, with certainty, I can tell you, meet your goals. And so again, I will put down 7, 8. We'll talk about 2, 3 of these, which are very important, but I'll mention all the worst enemies or pitfalls that you'll see in investing. These are the things which will stop you from meeting a financial goal. One is a now factor. That means goals which are 10 or 15 years away, somehow we have less interest or attach less importance to them. We attach more importance to our next car, a larger TV, redecorating a house. Like I gave that example, buying a motorcycle. I'm not saying any of these are wrong. I'm just saying we must, have goals for specific situations. Having a goal to prepay a home loan is a very good goal. But having a goal to buy a house is a very good goal. Having a goal to buy a new technology piece, it could be a phone or a TV or a computer, is a very good goal. But I'm just saying the now factor should not be where you're dipping into your long-term goals to satisfy your short-term requirements.
Right.
Another thing that's common is people who unfortunately are always so scared that they're always looking for the right time. I will not start now. Let things improve. Let things get better. Let me understand. That time never comes, and you end up putting money in your bank account, getting 2%, 0%, 1% return, and never really allowing compounding or accumulation. Like I said, now factor and redeeming your goal-based investments are two common things. Trying to time the market, we've already spoken about in the past slide. Herd mentality, which comes from short-term panic. Sab log bech rahe hain, everybody's exiting, the world is coming to an end, COVID will finish us all, the world will change. Of course it will change. The world is constantly changing. It changes every day. When the sun rises, the world starts changing. When the sun sets, the world continues changing. There's no end to it. But herd mentality is because of we have a lot of media, a lot of clutter, a lot of information, social platforms. So much information is coming to us, which is constantly asking us to react to information. When everybody's buying, and I always give this example, when your barber and your taxi driver and all these guys start telling you to start buying, that I'm investing, this is the time to buy, is the time to actually exit the stock market. So you have to work against herd mentality. It's never in your benefit as far as investing goes. Greed and fear is something we'll talk about. It's one of the biggest detractors to your goal. And greed and fear plays out more frequently than any other enemy that you have as regards to your investment. Chasing returns and accumulating wealth. I think chasing return, you should go to a casino. You should go for those runs that they have where you can bet money. To a large extent, even I would say, if you're buying and selling stocks frequently, is chasing return. It's more speculative, short term, versus accumulating wealth. Accumulating wealth, a certain small role is played in returns. The more important thing is to set aside money and to reach a goal which seemed very big. 8 crores seemed like a very big goal. It didn't really matter whether I got 11% or 13%.
Right.
My biggest achievement was I was disciplined. I set money aside. I allowed compounding to play. Compounding will play a very important role at 11% also, at 10% also, at 13% also.
Right.
So that is not so important. Compounding will play for you. But accumulating wealth is far more critical. Sometimes we lose sight because it's natural human tendency to look at your portfolio and feel euphoric when you get fantastic returns and feel completely disheartened when periods like what we've seen in the last 3 years. It is absolutely natural for a person to feel a little bad. Everybody wants to see fantastic returns on their portfolio. Okay, so I'll quickly go through. I think I'm eating up a lot of time, so I'll quickly go through 2-3 things. Another, inflation is one thing which is very, very critical. We plan for such long-term goals, not realizing that inflation will really reduce the significance of that. And I'll just give a small example coming back to the earlier slide of traditional insurance plans, which are at 3 or 4%. We must remember at 3 or 4%, we are not beating inflation. I know lots of people who are on an annual or a monthly or a bi-monthly or a quarterly basis buying LIC traditional policies with an idea that 30 years from now, every month I will get 50,000 rupees and I will be able to live my retirement comfortably. Not realizing that after 30 years, 50,000 rupees, the value of 50,000 rupees would not be enough to run a house. It would not probably be equal to 5,000 rupees today. So inflation has been forgotten because we are calculating our retirement on today's terms, not understanding in 30 years the value of money would change. Which is why, once again, long-term goals, investment products, traditional or low interest plans are detrimental to you. So these are some of the behavioral traps that I've spoken about. It's good to always have them in mind. And specifically now I'll talk about greed and fear. It's pretty much plays out every day in our lives. Every news article, and I'm telling you, so many times I'll open a Economic Times app. The first article will say that this market is not going anywhere. You should get out. The next article will be talking about why this is a great time to invest. So on the same page, both articles from renowned people from financial institutions. So the problem here is that you will read the article based on what current thought process you are in. So you will relate only to the article which, if you are greedy at this point, you'll read the article which says this is the best time to invest. And if you have fear in your mind, you will read the other article and that will drive your decisions. Greed and fear will play out a constant war throughout the journey. It will happen every month, every time you open the portfolio. Greed and fear will never leave you on an investment journey. And these are the two enemies that you have to necessarily overcome if you want to achieve financial success. Just a small example, most times, 99.9% of the times at the highest, like an example I gave of everybody getting and saying, yay, now this is the time I must put in all my money, must invest, is euphoric stage. Actually, that's the last worst possible time to put in lump sum amounts of money. And usually when nobody's buying, everybody's selling, people are so, that's where, at the euphoric stage is where you see greed. At the best possible time where you must put in more money, you see fear. And we saw this playing out in March, as close as March itself. And I think the point here is that, in the end, I don't think if you have a great financial plan, if you have goal-based investing, I think that is the only way this fear psychosis, this greed psychosis, the only way to beat that is to have a very robust financial plan, a very clearly articulated goals, and a very clear process on how you're planning to achieve them. That, according to me, as a human being, there is no other way of overcoming these two behavioral traps. So coming back to you, Surabhi, I know this is hopefully going to be a synopsis of everything that is coming to an end. Once again, before this slide, I'll request you to please do type in your questions. Any specific, as many questions, we'll try to attempt and answer all of them. But before we go to the last slide, my question here would be, Surabhi, what would, as an advisor, what would your suggestion, what would be the advice that you would give to investors in terms of what can be done to avoid the fear and greed trap?
I think it again has to go back to the very basic thing, which is like get your financial plan prepared. First of all, before starting any sort of investment or saving, you should know that what is your financial plan and how your future is looking like, or what financial goals that you would want to achieve. So it gives you a clarity, and once you have clarity, of course, you will have less of fears, and then link all of your investment towards those specific goal. For example, for short run goal for 2 years or 3 years, like you said, that we cannot invest into equity, right? So it has to be in a lower risky product that is giving you a lesser return, but at least a guaranteed return, because you know that you need that money after 2 years. For a longer run goal, of course, you can go into an aggressive investment, for example mutual fund, and then forget about those investment for next 30 years or 15 years, irrespective that what is happening. And that is how you cannot get into this trap. Market cycle is again something which is no one can understand, like you mentioned earlier, right? So just go with the flow, irrespective whether we are seeing a downside or an upside.
Set the right
And
expectations, understanding that
correct,
market cycles will happen. So these are
right,
something that we will all go through in our lives. Yeah,
right.
absolutely.
So it should not panic us, because that money is not required right now. That money is required after certain years. And irrespective what is happening in current market scenario, I should be disciplined with the savings that I am doing. I should continue my savings towards my financial goals that I have. And like discipline of course comes that I have to keep on continuing it. I would not wait that when the market goes down, that is when I will invest.
Even there, I think Surabhi, as an advisor, there's a financial plan and there's a process. Even at times where the timing in the market, to some extent, the process will take care of.
Correct.
There are annual reviews, 6 monthly reviews where we do de-risk portfolios,
Right.
where we also book profits and move into a staggered investment plan, etc.
Right.
So
Right.
I'm not saying that completely be blind to what is happening in your portfolio, but coming back to the initial, one of those supporters or friends or allies that you'll have is a process. I think
Right.
the financial planning process itself takes care of, to a large extent,
One
about
of the
timing the
process
market. Yeah.
is to review it, right? So
Yes.
time and again we have to go back to all of these things and see that how they are going. And process, like you mentioned, is only key to the success, right? So just keep on following the process and forget that what the news you are reading or maybe whatever is happening. So again, it's just the basics that we have to focus. And most important thing, like you said, that instead of focusing on the result, which is how much return I am going to get out of that investment, we should focus more on the goal. And if you focus, goal is again like its entire process, so focus on the process, and that is how you'll reach
and
to
and
the
we are not
desired.
saying returns are not important. We are saying focus on the goal, because returns will have happen 100%
Eventually, yeah.
eventually, irrespectively, if you follow the process.
Right, so basically it's the outcome, if you follow the
Absolutely.
process, yeah.
Absolutely. So that's pretty much it from our side. Apologies for boring you, but the business that we are in, investments, unfortunately, is a very, very boring subject, and I hope we didn't put everybody to sleep. I would have loved to be part of Bollywood and have a few songs and in the middle some videos. We are in financial planning, so it sucks sometimes. But that's pretty much it. We would love to take up questions if you have any. Our presentation, this is it from our side. Otherwise, um, I'll just one question I'll take from Dr. Narayan, if you're there.
Yes, good morning.
Good morning, Dr. Narayan. Good to see you. How are you doing?
So I'm very fine.
So I wanted to ask you something, if you're okay with it.
Yeah.
You've been with us for 7-8 years, and I know you would have invested with other people. Have you seen any real value addition happening to you because of a more systematic approach, or a financial plan based approach, or maybe a goal based approach towards investing? Have you really seen any significant
Okay. So before coming to that, let me tell why I organized this webinar, because I received one email from some company which I do not know, and then the title was that basics of finance for non-finance people. And I immediately, it stuck to me that I'm working with FinEdge, so why can't I arrange through FinEdge to get some? Because most of my friends to whom I recommended to start investment, even for my reportees, the scientists who were reporting to me, I tell all of them to start investment at the early age, because I started late. And I also explained to them. So what I was expecting through this is to make the people as if they do not know anything about how an SIP works. So those kind of details is what I expected. But then this was a broad, like a management thing. Like why the SIP gives more return. What are the different types of investment, and why should you go for SIP? How does it work? How does a fixed deposit work? How does this one work? That's what I was expecting. Because people who are present here, who are technical people, do not know how an SIP works. Why does it give more return? Because the NAV varies, and then what is NAV? Those, because I learned everything on my own, and then I started recommending to people. Like when I did not know anything about this, people could manipulate me, and then I because I was not aware of. Now if Surabhi talks anything to me, I know,
Hmm.
because I understand everything. Therefore, I can challenge her, and she cannot fool me. Otherwise, what happens is most often the technical people gets fooled by financial advisors, because they just come and tell something. Even I have got fooled when I did not know anything about this. So how I learned was when I lost my job and I was sitting idle for 3 years, I learned everything about investment, all basics about what are the different types of investment, even about policies. I learned how to switch funds because I became jobless. And that is when I started multiplying my amount. Till then, I did not know. So it was just sitting idle. So those are the things which technical people should know. So maybe if you can organize another session for people to, because then if they know about the details, like here you have explained, right? Like PPF and then traditional insurance and then mutual fund, you're saying 12%. Why is it giving 12%? How does it work? That if people know, then they will take more interest.
Absolutely. So I
And
agree.
how does the NAV varies and then why does it? So to be honest, in the previous slide, you also showed that some people waited because they did not panic, others panicked. And to be very honest, even some of my friends immediately asked me, shall I stop and shall I withdraw? I told them this is the best time to invest, but then they did not know that because I know the basics. I was calm. And even when Surabhi called me up and then she was giving I said, Surabhi, don't worry about me because I know how it works. That's because I learned about it. So, but then most of the technical people do not know. And then if you ask me frankly, majority of the technical people just go and put their money in fixed deposit. That is because they don't have knowledge about how the other investments work. That is it. So how to have a broader basket and then where are you supposed to invest apart from mutual fund and then how should it be going? Because they are zero in this. Like me, even I was so. So coming back to FinEdge, I am quite happy with FinEdge. That's the reason I have recommended to so many people, whomever I know, to go ahead and invest in this. But when I go and talk to those people, I explain to them how a mutual fund works and why it gives more returns. How does the NAV varies over a period of time? How does it fluctuate? And then, or when you invest for longer time, why it gives longer. So when I explain to them, they understand. Then they decide. But then if you just tell that it gives to 12%, we
Absolutely.
yeah. So that is the reason. That's the reason why actually I wanted.
So in fact, Surabhi also told me yesterday you had messaged her about what you're saying right now
Yeah.
as well, and we had this conversation. And the problem with a session like this is we are
Yeah.
talking to people where we don't know which stage of investing thought process that they're already on the journey, haven't started yet. We'll have different types of people.
Yeah. Yeah. Right.
While what you're saying is absolutely right, but I think one step, and even now, for example, somebody says, "Listen, I want to invest." We would go back and say, "Why would we say that? Let's get a financial plan made." Is because over there the entire explanation on why SIP and rupee cost averaging and how you average out reduces risk, accumulates money, all that will happen. But in this case, I think specifically why we didn't talk about a product is because we have varied people on this group. For example, if this meeting was only with you, we would talk very specific portfolio related stuff. So we try to keep it a little generic, not knowing which part of the journey or stage people might be on.
But then still, maybe others can ask questions because they might have
Absolutely.
performing fund, and then also maybe how does an SIP work? Why should it give higher returns? For me, actually, I did not organize this for me, for other people who.
Yes, of course.
All of them would have faced, or maybe even now would be facing what I was.
No, so happy to take questions, individual questions, anything that comes to their mind. More than happy to.
One question which maybe I can ask you is that for someone who is going to return to India like me, might be having a good a huge amount of this thing from the company as a retiring person, right? So when they come back as an NRE, they cannot keep it in the NRE fund for longer time. That is a limitation, right? So how are they supposed to proceed, and then how are they supposed to invest that amount?
So I think once you come back to India, you will change your bank account from an NRE to a resident Indian first of all, and then transfer the money there. That's the first step. So that by law, again, because you'll be filing your taxes, etc. over here, that's something which is required. So there's a certain time period which the government gives you to convert your account from an NRE to a resident Indian account. And I think the funds will move from one account to the other. That's the first step. So anyway, the money cannot be retained in an NRE account at that point once you move back. The second bit would be, of course, for somebody who's retiring, I think your objective of your portfolio, etc., will change completely. For somebody who's at an accumulation stage and a retirement stage, how and where to invest would change completely. But like your question was specific to NRE to Indian, I think that's the first step. The money will move into a resident account, and from there on, whatever you choose to do with it is something that is the choice that you will make.
Okay. Is there any specific advice as to what should they be? What are the options available, or?
So this is something that we can talk in more detail, but very generic. What I can tell you for sure is that for somebody who's retiring, we would not recommend any risky product. It has to be something which accrual. That means on a monthly basis, without eating into your investment, it should give you a certain amount of money, which should make your life comfortable. That is how retirement is supposed to be approached. So if, for example, you're at a certain age, how do we make sure that that money generates without taking risk enough returns to ensure that your monthly payouts, which is called, we call a SWP, systematic withdrawal plan. So where every month or quarterly or whatever requirement that you might have, that those funds are supposed to generate a certain amount of money, which takes care of or gives you the buffer in addition to your pension, retirement, whatever it might be, to live a comfortable life for the remaining 20, 25, 30 years that you might.
Okay. Yeah, others can ask questions. So when I actually, I was in Dubai for about 8 years, and one of my colleagues is also attending this. So I started investing. So I started one insurance policy at that time with one of the ICICI policy. And then after going back to India, I lost my job and I was jobless for about 3 years. So that time I did not have any knowledge about these uh, policies and switching funds and all those things. But I started because I wanted to invest somewhere. Um, so when I lost my job, I had to pay.
We've lost connection, I think, Dr. Narayan. I think
Because they wanted to make use of the situation and then advantage of the situation. They said if you do not pay the premium, then the money will get lapsed. Yes. But then ideally, I learned later on. I did not believe that because I'm a person generally who tries to educate myself. So I googled and found out that you have 2 years this thing, time for paying it. So you can wait them. Yes. And then I
Connection problem.
Yeah. Dr. Narayan, your connection is breaking up, so we keep losing you in the middle.
Okay, the internet was not good. So what I was saying is that since I did not have good education knowledge about it, they could fool me. And then later on, when I googled and realized that you can wait for 2 years, and within 2 years you have time to pay it, so you don't need to panic. Ideally, if I had gone as per their advice, then I might have uh, I might have discontinued my policy, and then
their advice was based on the fact that if you don't renew, their commission gets reduced. So I think one of the biggest, and our learning, and we've been part of the industry, and for everybody here, which is why we started off saying that, in the end, if you are investing in an insurance product, it's a scam. It's a scam.
Yeah.
The only
what I meant to say is that that's the time I learned about different types of investments and what are different types of policies and how to switch funds and all those things I learned. And then on I took after that only I came into. So I used to invest even in mutual funds before that, but then later on I became a client of FinEdge, and then I started working with Niharika first, and then afterwards other people, and now it is
and then Surabhi, I think.
Yeah, right. Yes. So I'm quite happy with the service provided by FinEdge, and therefore whomever comes and asks me about, because since they know that I have some knowledge about the investments, therefore they come and ask me to suggest something. Then I recommend to them.
So we will be happy to do another one if you want, which is very SIP specific. We do have those presentations already in place. We have in multiple corporates gone and given those presentations. So if you want post this at any point, you want us to schedule a very specific on advantages, benefits of investing through a systematic investment plan, we'll be more than happy to do a second session on that.
And then I can. Did my voice break?
A little bit, yes.
Yeah, I can ask my friends what kind of education they want, and then I can communicate to you, because it's basically for I just want to educate technical people with some basic knowledge. That's my basic idea.
Sure. Anybody has any questions, please feel free to ask. Any whatever you might have in your mind, anything you might want to ask. All right, I guess, Dr. Narayan, anything else from our side at this point? Once again, thank you so much for organizing this. Really appreciate it. You've been a brand ambassador, and it's really, really nice. And thank you so much for all of this. Look forward to seeing you when you're back in India. Anything that you want to add at this point? Anything that you want us to add at this point?
Thank you. Others, if any of you have any.
Harsh, there is a question which is there.
Okay, on the chat. 1 second.
Yeah.
Mr. Kapadi, right? I hope I've got the surname right. Very specific question to for retirement. Um, I think you still have 4 to 5 years left for retirement. Lots of things can be done for both. One is your goal that once you retire, how do I get accrual income month on month for many years after that? And second, because you have 4 to 5 years for your retirement, there's still a lot more that can be done because your comment suggests that you put all your money in bank FDs. I don't know whether it's in India or it's outside because you're working in Dubai, but there are two issues if you're invested in, if you're an Indian and you've invested in FDs. One, there's a tax which is there, which further reduces the income generated. Ideally, for a slightly longer term goal, 4 to 5 years, um, it's good to have a certain percentage of your portfolio into FDs because it gives you a safe return. And there's nothing, no harm in it, but keeping all your money in FDs might not be the best idea. I would recommend that get a financial plan made because that is far more detailed rather than me giving you just basic information. But from the look of it, keeping all your money in FDs at this point is not the smartest thing to do. There are better things that can be done in terms of returns. And I think your retirement goal is 5, 6 years away. I think you need to have two very specific goals. One is to get a certain amount of corpus in place by the time you retire. And the second part of your goal would be that how do I ensure that I get enough money from my portfolio for the remaining period of my life, where every month certain money comes to me, and there is no risk on my portfolio post retirement, because you don't want to be investing in equity products post retirement. It's not a good thing to do. I hope that answers your question.
Yeah, thanks a lot. It clears my mind.
Although you don't look like somebody who's approaching retirement from 20 or 30 years at least.
Yeah, because I am a cosmetic formulator, so I formulated product for my hair.
You look like you're in 22, 23s maybe. So I was surprised that you're asking me a question about retirement.
Yeah. So this is just a cosmetic makeover, I can say.
Mr. Kabri, please feel free to reach out to us. We would love to make, there are no strings attached. We don't charge anything for making a financial plan. Don't think that this is some sort of a sales session where we're trying to get you. A financial plan will really help you. This question will get more detailed and get answered on paper properly. We are not asking you to invest with us. This is not the agenda of this entire conversation. Financial plan will not cost you anything. There is no string attached that you have to invest with us or make any investments. You can reach out to us either through Dr. Narayan or send us an email and get a financial plan made. Some of these goals that you mentioned are very, very important. They do require a fairly detailed conversation.
Thanks a lot. We will be in touch.
Yeah, Harsh, they are aware that this was initiated by me and not by you. So there is no, I mean, they should not have any feeling that you are trying to.
Also, they should not feel that if they get a financial plan made, that means they have to invest. No such from our side.
I know they're all very close friends of mine, so they know me very well. So
yeah,
I can share Surabhi's number to him, and then I will also share his number to Surabhi, and they can disconnect him. We can maybe explain everything to him, give a big idea about what are investments, and you can just educate him, a brief education.
Yeah, I would be happy to do that, sir.
Thanks, doctor. Thanks.
So with that, I think we can close the session, Dr. Narayan, with your permission. And
yeah, definitely. Thank you very much.
Thank you so much once again. Really a pleasure having you, and you're an old client, and really a privilege to have this Zoom session with you. Thank you so much. Really nice of you. Really appreciate it.
Thank you.
Thank you, sir. Bye.
Thank you.